Welcome to this week's strategy session. Thanks for joining me. Great to have you with me. Not live this week. I'm not doing a live session. It's a pre-record. I'm pre-recording this on Friday morning, Sydney time. And a little bit different to usual. I'm going to cover the US market first, then move into the ASX. Then I've got the commodities. We've got gold, copper, uranium, lots of interesting things to talk about. As always, though, everything today is general commentary only, doesn't take your personal situation into account. Having gone through all that, let's get straight into our first chart. So I'm going to start with the SP 500. And this is a really interesting situation. Sometimes markets are straightforward, other times they aren't. And when I say straightforward, I don't mean easy, but I mean that the setups are clear and we can map out some possibilities with reasonable confidence. But at other times, and this is like where we are now, things can get a bit cloudier, and I'm very much finding this when I'm looking at all the charts. I'm finding this a cloudier situation. I'm going to show you what I mean. I'm going to start off with the S&P 500. Now, the series of all-time highs has continued through the week. So on Thursday, we had the S&P 500 at its 33rd all-time high this year. And the thing with all-time highs is all-time highs often lead to more all-time highs. So from that perspective, I think we can say the trend is up. And we also have a market that is bouncing off or rebounding or rallying off its 50-day moving average. I've got the 50-day and the 100-day moving averages on the chart. So we're rallying off that 50-day moving average after a brief pullback. And when we look at this chart on its own, we can just compress the price action, look at over a period of time. I think that the assessment that should be made from this chart structure is that it's bullish. It's a clear upward trend. And the base case remains, and this has been the situation since back here in look around November, early November. The base case since early November, when the S&P 500 got back above its moving averages after the mid-year decline in 2023, the base case has been that it's an upward trend and stay long, let profits run. Same has applied to the NASDAQ. So nothing's changed there. But I don't think we can ignore what's happening in other parts of the market. I don't think we can just look at this blindly and say, well, that's just how it is. So when I look at other parts of the market, now in particular, I'm thinking the Dow and the S&P 500 equal weight. So just going over to the Dow first, you see the Dow's been trading sideways for the last couple of months. So it's not confirming the highs that we're seeing in the S&P 500 and the NASDAQ. And the same applies when we look at the S&P 500 on an equal weight basis. So equal weight, it's where the bigger stock and the smaller stock in that top 500 has the same weighting. So that's why we call it the equal weight. You can see it's not confirming either. It remains below these previous high points from April and May. And when you actually look at the breakdown of how the stocks within the S&P 500 are performing, you'll find that around half of them, around 50% of the S&P 500 stocks are below their 100-day moving average. So it's not what you'd expect in a bullish phase of the market. Now, I'm not saying this is bearish, so don't get me wrong there. So I think this is still a bullish overall structure. We have a market that's tracking sideways along its moving averages. So that's a consolidating market. It's not a market which is in a bearish trend, but it's not confirming the highs at this point. Now, I'm not the only one pointing this out. I've seen around other sources of commentary where you'll have an analyst coming on, they point out there's a lack of breadth in the market. That's a lack of breadth is when you have a small number of stocks really driving prices. So others are pointing that out. And what's interesting is that what I've been noticing more and more over the last week or so is that when people are pointing out what I'm doing now, that there's a lack of breadth, the equal weight's not confirming, the Dow's not confirming, they tend to be being met more and more with ridicule. And people saying, oh, look, you don't get it. The equal weight doesn't matter anymore. The Dow's an old-fashioned index. We should be looking at what the S&P and the NASDAQ is doing and forget these other things. This is a response from, of course, not everyone, but but more and more people out there are coming with these quite abrupt points of counter view. And the interesting thing with ridicule is often a sign of arrogance and overconfidence. And if we know one thing from markets, they're two things that often don't go well in markets. So it's something interesting to bear in mind. And yeah, look, just take on board when you're managing the risk around what these markets might do next. So what's driving the S&P 500? So if so many stocks are currently not participating, we've got this sideways motion in a lot of the components of the S&P 500. What's driving it? And as I think just about everyone should know, a large part of that is NVIDIA, and also others like Apple and Microsoft are also helping. But NVIDIA is very much the big one. And now I'm not into calling tops in markets. I'm a trend follower. I let trends run. I let profits run. I use wide trailing stops. But one thing I am into managing risk. So sure, if you're in NVIDIA, you're letting your profits run, that's all great. Nothing wrong with doing that, using that wide trailing stop, trying to stay on the trend. But is this an asymmetric entry point for new money? And I'd argue that it's not. I don't think this is an asymmetric entry point into a stock like NVIDIA. And what I want to do, I'm going to put on an indicator to help demonstrate that. It's an interesting one. It's just it's a very simple indicator. It shows the percentage distance the current price is from the 50-day moving average, and you can see it's up around 40%. It's about 40% above the 50-day moving average, and we compress this up over a bit of time, and you just run your eye along here, you'll see 40%, it's about as far as NVIDIA gets before it does start to pull back towards that moving average. And sometimes this state of overbought can be relieved just by the stock going sideways and the moving average catching up. More often than not, it does involve some sort of a pullback in the price action. So from that perspective, I think the stock is historically at a stretched point. It's not to say it can't get more stretched, but when you're trying to balance risk, do you want to get into something which is already stretched and then relying on it getting even further stretched to make money? I don't think that's an asymmetric setup from the way I like to look at markets. And also we've got just on Thursday, very interesting, we've got a key reversal day has appeared. So key reversal day, market opens above the previous high, makes a new high, closes below the previous low, and we've got a new low. That's a key reversal day. These are interesting patterns. They often do mark at least some sort of a pause and a trend. Sometimes the market just runs over the top of them, but they're an interesting pattern to be aware of, and it's another risk flag that I think we need to pay attention to. And all this flows through the S&P 500. So if we just go back to our S&P 500 chart, S&P 500, and this is the influence NVIDIA is currently having. S&P 500 also has a key reversal. Probably not coincidentally due to NVIDIA having one as well. So NVIDIA's price action is really influencing the S&P 500 I think in a significant way. So we also had a reversal day in May for the S&P 500, led to a short-term pause and pullback. But look, let's just be aware of it and know that that's there at the moment. I continue to be long stocks. My preference at this point is to buy the components, not the index. And I'd rather be buying stocks that are breaking out of ranges, which are rallying off moving averages, rather than chasing stocks like NVIDIA, which have already had big runs, which are already stretched above their averages. So as I say, I'm managing risk. And that's what we all need to do in the stock market. We need to manage risk, not just run blindly after what's running. I'm happy to hold stocks that have run hard, but I don't want to buy them. I'm fully aware they can run further, and that's fine. That's why I hold them if I've got them. But as a risk manager, I don't think a lot of these stocks at the moment, I don't think a lot of them offer asymmetric opportunities. And I'm also using those wide trailing stops that I often talk about to try and see off pullbacks, the pullbacks which many stocks within the S&P 500 and markets generally are currently experiencing. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It helps a lot because YouTube sees that and then goes and shows other people. So that helps me, helps my channel a whole heap. So please do that. Click that subscribe button if you haven't already done so. Now, let's move across to the Aussie market. I'm going to have a look next at the ASX 200. And this is such a distinctive trading range, which is now very much been forming on the ASX 200. And you can really see the price action coiling up. You can see how the last 2 months it's really been coiling. See the top boundary of the range is declining. The bottom line is rising, so it's contracting. It's called we actually call this a triangle trading range just because of those converging lines. And had another rally off the lower end of the lower end boundary through the week, just moving back up to the it's still in the middle of the range, but the upper end of the middle, and also rebounding off the 100-day moving average. You can see the 100 and the 50-day moving averages on the chart, and we're rebounding off the 100. So it remains very much a case of, I think, dips being bought, which is what we want to see in a healthy market, in a market with bullish undertones. So the dips are being bought. On the flip side, though, as this is a range, we also have distribution coming in at the top of the range. And this is how these ranges play out. It's essentially a standoff. You got a standoff between the buyers and the sellers. The sellers at the top, the buyers on the bottom, the price compresses, and ultimately one side prevails and we get a breakout. So it's very much a waiting game. It's a waiting game until we get a break either to the downside or the upside. I continue to work on the basis that the overall structure is bullish. So my favored view is that we get an upside break from this range, but of course that's not certain by any stretch. But I think I think the bias is towards an upside break because I think the underlying trend is up. I think from the October low we have a rising market, and we then have a consolidation. And the consolidation is all just part of what happens in a rising market. You get a market that runs and then it consolidates. And that's where I think we are now. So unless we get a break to the downside, I think the probability continues to favor the bullish case. I did sell a stock through the week that was breaking lower and had hit its trailing stop. But overall, I'm continuing to remain long stocks. I'm using those wide trailing stops I'm always telling you about, the aim to try and see off this big consolidation we're getting in stocks generally, and stay with my profitable positions. I have plenty of positions which are well in profit. I don't want to get shaken out during a sideways period if we then get a break to the top side. I want to still be on board. Break to the downside, well, then I've got stops there which can get me out if need be. But I want to stay on board if possible. And but one thing I am doing, I am being a bit cautious with buying new stocks. I'd really like to see this trading range play itself out and break to the upside. I'd like to see that momentum start to return to the market generally. So until that happens, I'm just being a bit on the cautious side with new money going into the market. What's been interesting is there's plenty of news about the economy in the media at the moment, and there really has been. There always is, but at the moment we're really seeing the news flows seems to be quite downbeat generally. What I find interesting is, so when we look at a financial ETF, so this is the beta shares ASX 200 financial ETF. So we're getting this downbeat commentary around the economy generally, but when you look at the financials, they're making new highs. This is not giving us signs that the economy's really lurching lower and starting to deteriorate. It's financials are doing well. So this is generally led by the banks, but financials generally. And this is a marker we've been watching for a while. We were talking about this back in November, and this was one of the things we used to identify that emerging positive tone we're getting to the market in October, November last year, as this started to get above moving averages, started to break out, and then following this trend upward in financials, we did have this pause. We had a pause for a couple of months, and then I think it was 2 weeks ago, broke to a new high. So everything remains positive on that sense. So overall, I'm remaining cautiously optimistic around these markets. I think we've got some clear levels to watch in the ASX 200 around this range, and I think that a good risk management strategy can really help. Can really help us play the long side while still keeping our risk in hand. I think that's a way to do this. You've got to have that risk management strategy in case things start to deteriorate. But if they don't, it's a case of staying with that overall underlying momentum. Now, I'm going to move on to the small ords in a moment. I've got the commodities to go through, so plenty more interesting things to have a look at. But of course, that wraps up the free section. So if you're not a strategy session member, there's a link below. You can click that. You can come in. Lots of interesting stuff to look at, and it doesn't cost you very much either. So think about doing that. Now, okay, let's start with the small